All right. What's up, Danny?
Hanging in there, man. How you doing?
Pretty good. Pretty good. We're gonna take a look at some intermarket correlations between the forex market and some other primary asset classes to give you an idea of a different style of trading or a different trading strategy. So one intermarket correlation that tends to work well. You can take a look at the correlation between USD CAD. Yeah, no USD is not changing up there. And you can correlate that with the movement in crude oil, right? So I don't know if that.
We got to cover stocks and bonds too.
Huh.
Let's do stocks and bonds next.
Okay. Oh, that's so strange. Okay, here we go. Okay, yeah. So here, let's compare apples with apples. So same time frame. Yeah, so very strong correlation that people can use in the markets when looking at other cross asset classes is using the correlation between the price of crude oil and USD CAD. As you can see here, between the two charts, crude oil at the bottom and USD CAD trading at the top. So what tends to happen here is that when crude oil rallies in value on the day, what that tends to do is that it raises the price of commodity currencies. Canadian dollar being a primary commodity currency that's linked to crude oil prices, it will tend to react to large spikes in crude oil price movements. So as you can see here today, crude oil price went from like, $57, hanging around right here, and then it did this one big pop right here. It's now trading at 58. So you're seeing like a big spike here in crude oil prices. And you can see here in the relationship to USD CAD prices, you can see US dollar selling off pretty hard against the Canadian dollar. So reacting to that price. Yeah, what's up?
Yeah, no, I just wanted to interject real quick. Why is that the case, right? Because when you have commodities, they're valued in US dollar, right? So it's kind of like a forex pair. So you have your commodity priced in US dollars. So when you have the US dollar going up, that's the thing in the denominator, right? It's like Euro USD, right? When the USD goes up, fundamentally the euro against the USD is going to go down. So it's the same thing when you have commodities that are priced in US dollars. That's why they do that, right? So when you have commodity currencies, which are currencies that for which the country produces a lot of commodities that are valued in the U.S. currency, etc. When the value of the U.S. dollar goes down, those currencies appreciate, and vice versa.
Yeah, so this is a very, very good correlation. Obviously, correlations do break down, so you gotta use it with a bit of caution. But having a good understanding of how these correlations work and how the economy is linked to the commodity and its reaction to prices gives you an extra edge in the markets, right? There are many other products that you can look at that gives you the same up to the minute, or I can say up to the second price action correlations to kind of give you another signal. So do you know any other forex correlations that you want to take a look at, Danny?
Not off the top of my head in forex. I mean, we could take a look at like the USD against the Japanese yen versus bonds. But what I wanted to kind of highlight was,
or we can take a look at USD against bonds, right? I mean, that's a perfect correlation.
There's that one too, yeah.
Yeah.
And I also wanted to get into stocks versus bonds.
Yeah. So this is a good one. USD yen and USB 10. Oh, sorry, it's USB 10, which is a 10-year U.S. Treasury note.
And this is one of my favorite correlations, by the way.
Yeah, and these two products have a very strong correlation. So you want to explain how this one works?
Well, I mean, basically, we have two risk-off products, right? We have the U.S. 10-year Treasury note, and we also have the Japanese yen. But of course, it's in the denominator. Like this one is the quote currency, right? So it's basically flipped. So we have the United States dollar, which tracks yields. And maybe you could explain this a little better because I just kind of like know it. You've taught it many, many times. But basically, because of that relationship, you have this very strong inverse correlation between the price of the the U.S. 10-year Treasury note, for example, and what the yield. Don't forget that the yield and the price of the Treasury notes or bonds or whatever vary inversely, and that's not an arbitrage type thing. That is fundamental to the calculation, right? Fundamentally, they are two things that are intertwined and they're inverse to each other, right? It's not like the thing we were talking about before, which is like oil and USD CAD against the dollar. These are things that are fundamentally tied together, right? Now the US dollar tracks the yield of these bonds, right? So when you have something that's tracking the yield of these bonds against the Japanese yen, which is a risk-off product, you're going to see these correlations as we have laid out. Was that a good explanation, Chen, or do you want to add anything?
No, that was absolutely perfect. You couldn't have explained it better. I mean, while you were talking there, I switched the bottom chart here to the yield as you were speaking, and you can see that correlation over the last couple of days is a mere correlation between dollar yen and how it reacts to the yield. If you change it to the price, which is what we use as a trader, as you and I, we both know as a trader, what's our favorite product to trade?
Well, of course, it's going to be bonds, in particular, the U.S. 10-year Treasury note.
Right. And so we tend to trade this product, but this product is mathematically linked to the 10-year yield, right? And the yield, when you saw the previous chart, has a pretty much mirror correlation. So that's pretty much how you use this type of product when it comes to trading, right? Using two forex pairings, such as USDCAD, and dollar yen, and you're linking it to a commodity and now to this a bond product.
Sure. And another thing I just want to interject real fast about why we like trading bonds. Chen and I love trading bonds is because the bond market is pretty much going to drive everything else. We have a saying that the smart money is in bonds. Bonds are a very difficult product to trade. It's a very institutionally driven product to trade. However, what the bond market does, we're going to see those effects bleed through all the other markets, currencies, stocks, commodities, pretty much everything else, right? So through these intermarket correlations, you're going to see the effect in whatever product you're trading.
Yeah, that's perfect. So again, these forex products over the last couple of days pretty much tracks all the news and all the events, and you're just basically seeing how the correlations works between various asset classes. So it's a unique thing to take a look at. You got anything else you want to say?
No, let's just move on to the, we can maybe take a look at risk on, risk off sentiment versus how that affects, say, the SP 500 ES contract and how that varies with the US 10-year Treasury note that you have on the bottom. So maybe just switch out
US.
Yeah. In particular, we're going to have the
so this here.
Yeah, that down Elliott wave thing in the ES from the Trump tweet.
Yeah. Well, I mean, again, now you're taking a look at like the S&P 500 and laying it over the 10-year T-note, right? Obviously, this is a very strong correlation, and it's very important to watch these markets move together as a trader, because you get very strong signals, especially when the market starts bouncing around here and you're seeing a lot of weakness in this market. Watching some of the other correlated markets will give you a sense of when this is going to break out. And so it gives you very important distinctions, indicators, so to say, in the markets using other live traded asset classes. But you have to understand what the asset class is trading and the importance of it to understand the correlation as well.
Yeah, not only that, being able to understand the risk sentiment in the markets and how that's going to bleed into your product. Like we see in particular as we get toward yesterday and today, the more the right end of both of those charts, you see these big giant moves, and that was caused basically by a Trump tweet where he said, I'm not sure really we're going to have any kind of trade resolution going on with China. And as we know, that's been the theme of the markets for like the past 2 months, right? Is this China trade deal? What's going on with that? And so when he says something that's doubtful as that, we're going to see that bleed into bonds and stocks in particular, of course, all the other assets. But really what's going on is you're seeing a risk off sentiment. If you remember, there are certain products that are what we call risk on versus risk off, right? So when we are in a mode in the markets where market participants feel that they can get a reward for putting in a certain amount of risk, we say that that's a risk on mode, right? Risk on products are like stocks, because the stock market goes crazy, you can lose a bunch of money, blah, 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 versus bonds are a risk off product. Why? Because they have a guaranteed yield that you're going to get no matter what. So when people are freaked out in the markets, what do? They take their money out of risk on products like stocks and they put them into bonds, for example. And it's a great example of what we see down here in the bottom, where the stock market just sells off like crazy and the bond market rallies in tandem. That's why that happens.
Yeah, that's perfect. Yeah, we'll keep it at that for this nice little lesson about forex correlations and how it can be used across various asset classes to give you an edge in your trading. Anything else you want to say, Danny, before we wrap?
Yeah, why don't we just link it into the Ghostsquawk real fast and how people can get a feel for the risk on versus risk off sentiment in the markets. So this is a tool that Chen and I have created. I wrote it. My background is programming. If you guys have been following along in the lectures and the YouTube stuff that we post, you've gotten a chance to get to know me by now. But basically, this is a product that we've created. As we've been mentioning in our lecture thus far, the theme here is risk on versus risk off. And that's not exactly easy, especially as a beginner, to ascertain, right? If you're looking at you're doing your homework, you're getting up every morning, you're looking at, the news and all that. It's not exactly easy to ascertain, is it a risk off or is it a risk on tone, right? But I have basically done the legwork for you and wrote a natural language processing algorithm that goes through all the news in real time and tells you how much is risk on and how much is risk off. So if you see in the upper left-hand corner of the Ghostsquawk, that's our product, by the way, of the Ghostsquawk, you could basically see a tally, so to speak, of the headlines that are risk on, that are risk off, and that are neutral, right? So if you see here, it's in red. Risk on, there's only 4 articles. Risk off, there's 15, and neutral, there's 30. Basically, what that's saying is that we're pretty much tilted to the risk off side right now. And a lot of those, we're going to be putting together a module that highlights a lot of this and how you trade it. But we have many, many examples to show you of when the scales are tilted one way or another to risk on or to risk off, and how that affects the markets in real time. So yeah, that's pretty much it.
Oh yeah, that's perfect. Yeah, and don't forget the Ghostsquawk. That's really cool too. You can now get Ghostsquawk stuff here.
Yeah, exactly, man. Represent for the home team. We got shirts and coffee mugs and shit. Check it out. It's fun.
All right, we'll leave it at that. All right.
Sounds good, buddy. Good stuff.
All right, so
you stop recording?